However, China has usurped gold, classifying it as the only liquid, zero counterparty risk, high quality liquid asset. And that is why global central banks, alongside sovereigns, Western facing institutional investors and borrowers, are being onboarded at unprecedented rate into SGE physical backed exchanges. The CME LBA wonder why this liquidity is disappearing. And what does it involve? It involves selling dollars to buy gold. China has now gained full control of the physically settled gold price setting mechanism, and to accommodate Western facing participants who are in the advanced stages, they're opening up the Western facing global gold corridor. We can all access it. Investors can buy and pledge high-quality liquid asset gold.
According to Andrew Maguire, the true story taking place in the gold market is about a quiet change of power rather than hoopla. He contends that the rise in gold's value is due to the dollar and other fiat currencies declining actual purchasing power, rather than the metal's unexpected increase in value. While Western investors concentrate on short-term price fluctuations, countries like China and India are covertly depleting the physical gold supply by purchasing more bullion than all Western ETFs put together. He cautions that Western officials are becoming increasingly desperate behind the scenes. In an attempt to challenge China's bullion hegemony, some have even suggested selling the United States' official gold stockpiles, a strategy Maguire deems unfeasible. He contends that the US gold has probably been rehypothecated several times through the paper markets, indicating that those bars have already been leased out and claimed across several tiers of financial transactions. Unwinding that would reveal enormous leverage and would cause gold prices to soar rather than decline. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing.
So the de-dollarization process is a natural event. And circling back to who and what was likely behind the official gold pushback against an out of control China orchestrated BRICS plus dollar to gold de-dollarization escalation, i.e. just swapping dollars for gold, of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, which will actually be enormously beneficial for the dollar, let's examine the various possible official White House to BRICS pushback options. Now, what could they be? There's really basically a couple. It could threaten to sell all its gold reserves. These things have been discussed. They could threaten to sell all their gold reserves in an attempt to devalue China's BRICS influence. Really? Given that deliberately unaudited US Treasury holdings are to an unknown degree rehypothecated with double ownership claims. So in order to sell its 8,100 tons of gold to effect this pushback, the US Treasury would have to first buy back billions of related underwater Office of the Comptroller bets, which would spike gold even higher. It's too late. The horse has bolted, and the US is left holding less than 1/10 of what the BRICS collectively hold. Less than. So US gold reserves are literally far too small to actually push back. And another reason, and this is another one which we've seen in the past. I think Saylor talked about it. We had various other people in the past pushing back and saying, hey, well, why don't we do this? Especially with the stablecoin mandates being pushed out. So the other idea, and this is what we're going to look at, is that, because it's been trial ballooned more recently, that the US Treasury may try to back its 38 trillion of debt. And that's just official. It's much larger than that, but let's just say they want to back its 38 trillion of debt with freshly generated dollar-backed Treasury stablecoins. Now, however, and essentially what they're doing is that would attempt to devalue this 38 trillion of debt by forcing US Treasury debt on other global central banks. In other words, you've got to use our stablecoin. However, this ignores the fact that the physically gold-backed yuan stablecoin is already one-to-one exchangeable for gold. And those being forced to receive these dollar stablecoins, trade with them, have the option of immediately squaring these debt-backed dollar stablecoins back into gold by way of instant settlement into BRICS, Russia, Chinese-led gold-backed stablecoins, thereby laying off this US dollar debt. I don't see it happening. I don't see it working. Now, this relentless BRICS gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by one of two events. And we've looked at this: either a massive bid only, T+1 margin call, spiking gold thousands of dollars higher, or far more equitably for the US, resolved by a more orderly US Treasury gold price revaluation. And of course, all the liquidity providers, all the smart people are saying, well, of course, they're going to choose that option. So, yeah, you can trial balloon all this other stuff, but there's the reality of it. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside of the CME LBNA ring fence, the stealthy gold revaluation process that already commenced directly after the BIS revalued gold has gathered sufficient global momentum to force the US Treasury gold to be competitively revalued. Once it's revalued, the US will want a stronger gold price. And as we've been drawing attention to, every single non-dollar denominated fiat gold price, pound, yen, whatever, euro, whatever you want to look at, has been dragging lagging dollar gold price into its all-time highs. They've all been into all-time highs way before gold did. And yes, we will see from time to time the US is able to push back the dollar gold price from time to time, as we likely see again today into gamed FOMC volatility. But it's limited to how much COMEX derivative open interest can be laid off against a dwindling number of speculators siloed outside the real market price setters. They don't even know what that price is. And as we've been focusing on, the real game changer is that China took off the gloves the moment the yuan gold became fully Basel III compliant, and opening up Western-facing institutional grade one-to-one ability to one-to-one vault their bullion in vaulting facilities, which are able to eliminate unallocated gold counterparty risk. It creates a much more stable environment. Your gold is stored in physical environment.
According to Andrew Maguire, the present increase is unrelated to speculation since China has subtly taken over the world's gold and silver markets. It is driven by actual, tangible demand. Due to the rapidly tighter supply, customers are now accepting actual metal deliveries rather than paper contracts. That's a historic tipping point, according to Maguire. Since gold is now the only genuinely liquid asset with no counterparty risk, large investors, central banks, and sovereign wealth funds are shifting to physical exchanges, particularly those associated with the Shanghai Gold Exchange. He says that as short-term speculators are driven out, both gold and silver are going into stronger hands. While major commercial players continue to covertly purchase genuine bullion, momentum traders who solely depend on price fluctuations are being caught off guard. Maguire says the balance of power has now shifted to the physical market. New York and London no longer dictate where prices go, Shanghai does. And that's why, he says, this rally feels different. It's not being built on speculation or leverage, it's being anchored by real metal, real demand, and real delivery. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
However, China has usurped gold, classifying it as the only liquid, zero counterparty risk, high quality liquid asset. And that is why global central banks, alongside sovereigns, Western-facing institutional investors, and borrowers, are being onboarded at unprecedented rate into SGE physical-backed exchanges. The CME LBA wonder why this liquidity is disappearing. And what does it involve? It involves selling dollars to buy gold. China has now gained full control of the physically settled gold price setting mechanism, and to accommodate Western-facing participants who are in the advanced stages, they're opening up the Western-facing global gold corridor. We can all access it. Investors can buy and pledge high-quality liquid asset gold in Hong Kong, in Singapore, and then you've got the SGEs opening up vaults in Zurich, Dubai, multiple cities in Africa, South America. I mean, it's done. they've usurped the entire gold market. So circling back to very short term, gold and silver are rapidly moving into strong hands with very large short stops layered above the market and naked long momentum specs rinsed and commercials one-to-one taking the long side of freshly retrenched naked shorts. You can see them active. They're trying to fight this rally. Momentums do not like sideways action. They want a direction, and they will be wrong at both ends. And once again, that's exactly where we are in this process. So I think what our liquidity providers are simply saying, look, this physically driven gold rally has simply paused mid-rally, with fresh 2026 targets being assessed as high as $8,000. Now, they're deliberately constructed a bearish head and shoulders structure, which is a classic bearish structure that technical traders may either try to create if you're a market maker or a cartel, and you've got control of the futures markets. But this head and shoulders pattern was really designed, or really will have emboldened momentums to go short. So we still may get the odd pullback here. And that's nothing, or the short-term overshoot of what is really very, very strong physical support. But this would require a lot of fresh naked short supply, and there is not enough open interest. In other words, COMEX chips for the COTs exposed, the commercials, exposed to T+1 delivery obligations to hedge against this purely synthetic structure. And we saw them attempt the same thing in silver. But again, for the same reasons, there isn't enough open interest, derivative open interest, against physical demand for them to be able to. This is no longer just a synthetic marketplace. The prices are being set outside of the COMEX. And just based on this alone, you only have to listen to mainstream media. You only have to listen to those with a vested interest for the gold price to go down. All the usual suspects are calling for a deeper correction. At best estimate, looking at the paper to physical structure, we figured the momentum-driven naked short overshoot may have had sufficient momentum to briefly breach the gold futures 39 level, which it didn't. It was only $1.50 above that. Bearing in mind that futures traders are, and those exposed to physical delivery, T+1 delivery, will be long gold futures to hedge any kind of breach of 3,900. And we figure by this point, even the most bearish projections will have been exceeded, and commercials will be actively hedging physical exposure, which is what we see at the moment.
According to Andrew Maguire, China has essentially taken over the world gold market, changing how the commodity is valued and traded. He claims that gold is currently the best collateral available since it is the only asset that is really liquid and has no counterparty risk. As a result, Shanghai-based, physically backed exchanges are attracting central banks, sovereign funds, and major Western financial institutions at an unprecedented rate. Traditional Western paper markets like the COMEX are losing liquidity as a result of this change, forcing traders to sell paper contracts in order to purchase actual gold. To help international investors accept this new method, China is building a global gold corridor that links South America and significant vaults. Maguire claims that China has usurped the entire gold market, completing this process. Meanwhile, gold and silver are quickly moving into strong, long-term hands, pushing momentum traders and short-term speculators out. In order to trick traders into placing bets against gold, he continues, market makers have been attempting to manipulate prices by creating a negative head and shoulders pattern in the charts. However, it's failing this time because there isn't enough paper gold in the system to sustain significant fresh short positions. The real market has taken control. According to Maguire, even slight declines would necessitate a huge new short supply that is no longer available, because liquidity providers have already set 2026 targets as high as $8,000 per ounce. He thinks the current surge hasn't concluded, but has only stopped in the middle. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.